Welcome to week 15. It is the 8th of April. There's quite a bit to kind of go through. I always kind of start off thinking on the weekends, oh, there's not much to talk about, and then I kind of end up having way too much to talk about. But I hope to focus primarily on two things on this call. One is going to be looking at a few things surrounding sterling, given obviously April 12th, at least as far as we know, on Brexit, as well as touching also on kind of what's kind of going on the equity side. I'd overheard a few things around kind of internally that I think people maybe kind of missed us covering in a few kind of earlier macro Mondays in the year, and I just wanted to give kind of the right kind of context because I think people are really missing kind of the significance of some of the moves, as well as more importantly some of the volumes out there. So we will definitely be spending quite a bit of time on that, and then there'll be a few other bits and bobs as we kind of go. As always, everything covered is solely views, opinions. These are not trading nor investment recommendations. So a few of the things that kind of stuck out last week, we have now kind of gotten the elections, quite a bit of a sting to Erdogan, biggest kind of defeat, if you will, in the 15 years that they've kind of been on power. I know they've also been calling for recounts in some kind of areas. Obviously, the key thing the market will be focusing on is what next now that we're kind of through on that. As we know, the currency has been under a lot of pressure given kind of the funding kind of issues, and there's a lot of kind of ongoing things that are quite dynamic there, not to mention also on the geopolitical front. Again, Turkey, try assets, would be it credit, be it on the equity side, are just worth always kind of keeping on the radar because a lot of Turkey's problems really stem from one person. And if at some point that one person was to go down or to do a big, remarkable kind of pivot, then again it could be quite asymmetrical opportunity. So just kind of flagging that, at least from the EM side. It used to be an EM darling, and definitely not in the limelight for the right reasons, at least at the moment. Going on US, we obviously had jobs data last week, came in better than expected, 196, 177 was expected. We also had revisions upwards to the previous figure. So if you recall, last time we had the big miss at 20K, and I believe that was written up to 33. We did see, though, misses on probably what is arguably a lot more important, which is, of course, the average hourly earnings, 3.2 versus 3.4, suggesting that, again, there's no inflationary pressure in the near term, at least kind of feeding through. Still, I guess, too early to know how much of this is like structural and we're kind of going back lower in CPI and inflation, and how much of this is just maybe a little bit of the oil pullback that we had towards kind of the end of kind of last quarter, and we'll also touch on oil kind of later on, as well as the energy kind of ETF there. What was probably the most surprising and driving of the risk-on sentiment last week, especially following the very strong close to the first quarter, was PMIs that came out a lot more positively than expected. Most importantly was China, which came out kind of last weekend. So actually a big chunk of the gains from last week did get kind of set on Monday, right? Whereas the market was kind of catching up with that kind of news on positive kind of PMI developments in China. Pretty big beat back into expansionary territory on the manufacturing PMI in China. Obviously, one data point does not a trend kind of make, but this kind of goes back to the macro Monday thesis where we are expecting some kind of uplift in second quarter data. Not enough to, let's say, get the ECB back on the hawkish path or the Fed back on the hawkish path, but definitely enough to take out a lot of the dovishness and rate cut kind of expectations, and a little bit of a recalibration, at least from that kind of sound of things. And also a big push of that was very much seen on the equities and kind of fixed income side. We had a big push back up higher in yields, and we actually have bonds which were just close to almost -8, -9 basis points, are now back above zero. JJBs, which are minus 10 basis points, are now still -3, and US 10 years, which just a few weeks back were 237, and now back at 2.5. In the 30s, these 290, 291 levels that we've seen. So really kind of big moves. Central bank decisions. We had said RBI you couldn't rule out a cut last week, and that's exactly what we got. It looks like the market was maybe expecting a little bit more of a dovish kind of tone, but we still kind of believe that that a lot of this was triggered, or should I say influenced, by the fact that there's elections kind of going through in India, and we actually saw new highs, all-time highs on the Nifty prior to kind of the pullback after kind of the cut kind of went through. RBA was a little bit less relevant again post that kind of China big beat, potentially giving them a little bit more breathing time, if you will. With that said, those slight tweak in statements that could be interpreted as making it easier for them to make a cut next time around. We also should potentially be expecting a downgrade in growth expectations, potentially even inflation expectations on the next kind of quarterly update, which I believe is not coming out until early kind of May. So that potential May meeting could be interesting in regards to them actually kind of doing a cut. So food for thought. We still kind of remain above that or flirting with that kind of 71 cent kind of territory in Aussie. Amazingly, we still have not broken kind of that 70 cents, which is a pretty big level. And actually also the shorts are not, let's say, elevated on extreme kind of one-year levels by any kind of means. So still potential kind of headwinds potentially to get in front there. On the trumpet kind of side of things, as always, there was, again, further chatter on U.S.-China, him talking about an epic deal, but still kind of indicating could be about 4 weeks away. I believe this was kind of Thursday, and the market is now hoping to see some kind of Xi-Trump summit or agreement before the end of April, but we'll have to kind of wait and see. We had a few more threats on the Mexican border that seemed to kind of quiet down as we got towards the end of last week. He was talking about slapping tariffs on Mexican autos, imports into the U.S. What he obviously probably does not fully appreciate is the implication that would have on U.S. automakers, who also have a lot of business, obviously, and a lot of plants in Mexico there. But I think it's just classic playing up the security border, again, bearing in mind that 2020 is re-election, bearing in mind that he's running on kind of the wall, etc., right? And then again, we've seen tax returns coming back up as another kind of quest on the news flow, and of course this is probably the epitome of an oxymoron, as I'm sure his tax returns will be no returns at all, but would love to see him. So anyway, we'll stay tuned on that. I don't think it's a big deal either way. I don't think it'll be surprising if we find out that he's not paid any tax for a while and has the mother of all tax credits. On the equity side, pretty much a sea of green, as you can see. Big movers. It's, you pick where you want to pick at the end of the day. It was interesting to see EM ETFs doing very, very strongly for the week, up about 3.5%. Ditto on Chinese equities, just continuing to roar, and we'll spend a lot of time on that on the charts. Close to kind of 9% on the CSI 300 just for last week, up 35% in local kind of currency terms. In dollar terms, it's up even more, and this is not even the best performing equity index in China, right? That's actually the Shenzhen index, and that's closer to 44% in dollar terms. And again, bear in mind, we're barely past the first quarter, so these are huge numbers, no matter what index you're really looking at it, because what you should be basically doing is annualizing these numbers, and roughly that's 4 times whatever these are showing, and it kind of gives you kind of a bit of the metric of where we are. So you're looking at stuff like the NASDAQ at 20%, so that's annualizing 80% kind of returns for the year. The Shenzhen comp is up 44% year to date, so that's obviously annualizing way over 100%. Context here is how much of this moves are sustainable, right? And obviously anything is possible, but the probability of them continuing at this kind of expansive rate is very, very low in my kind of opinion. But we'll continue kind of touch on that later on. Fixed income we already touched about. Big kind of reversal, bonds back up above zero, but again, I still think the structural play is lower. The question, though, is if we continue to get kind of good economic data, how far the back end bond yields kind of pull. And actually, a lot of the macro guys I'm talking about, this is kind of the thing. They do want to be structurally long fixed income if they are not already. So the question is, where do you add on, or where do you get in if you've not gotten in and you've actually been sitting on the sidelines, etc. And if you're already in, how much of pain can you kind of be expecting before potentially adding on, or maybe actually even being forced to kind of close to kind of get back in later on. US dollar was basically a tail higher versus the euro and especially the yen, but pretty much was a loser against EMFX, with the sole exceptions really of TRI and the Argentina kind of peso. Very big week for dollar ZAR, with the ZAR strengthening, almost kind of close to kind of 300 kind of basis points. It will be interesting to see if that's the start of a trend or just a tail end of something else. And on the commodity side, big move up higher on Brent crude. We did close above 70, which is quite kind of interesting, and it's just kind of been a very consistent kind of grind up high. And we also have OPEC meetings that are coming up this week, which could be interesting. Platinum and iron ore also had very, very good weeks, with being plus up 6%. And on the volatility side of things, it's the same. Continues to degrade lower. Now in equities, we were about 6.5% lower for the week. We're about these 1282 handles. What does that mean? Again, from an options perspective, it's quite cheap, especially kind of historically, obviously. So easy to express views either way, whether you're looking to hedge, whether you're playing for the downside, or whether you think there's potentially a lot more upside and you prefer to play that through options and at least know the most that you can kind of risk by being long. On the CART report side of things, we will have the actual table on an updated version, as we still only had from Ole's piece last week's kind of table. But overall here, the data points are up to date. We had a big increase of about 14% in USD net longs. Now bear in mind, these are much more interesting numbers than previously, because these take into account the end of the first quarter. So you could kind of see that lift up that we had in US dollars to about 27, 28 billion against the 9 IMM kind of currency kind of futures. The biggest moves was still again in euro, and the extremes on the 9 IMM still continue to be in euro, MXN, and ruble, which should not be surprising, those two kind of being on the emerging market side. But still surprising. To me, that we are not yet. Extreme. And the likes of, let's say, Aussie To be honest, I think that's just a question of time before we see that. And then also potentially maybe also the yen and the Swissy if we continue kind of on in this kind of risk-on kind of environment. So just kind of food for thought. This here shows you the euro and the yen. The yellow line is really the one to kind of pay attention to, as in that is the net kind of positioning. The black is kind of gives you an indication of where kind of spot is. So you can see we continue to make newer net shorts in the euro, but we have been shorter before. So especially kind of 2015 period, and on the yen we've definitely been also net shorter, much bigger kind of positions than kind of where we are now. I thought it would be interesting to just throw a sterling chart of the US dollar on cable here. As you could see, we went from being very, very short towards middle of back end of last year, start of the year, to now getting very kind of close to neutral as we kind of approach the potential end game of Brexit. Commodity side, I'll just leave this one here for you all to take a read on the hard copy deck when you kind of get it. I guess what's probably most interesting, given what's been going on, is kind of the big move up higher that we keep on having in oil, and people continue to just kind of get net long Brent. What's interesting is not a lot of people seem to really be talking about this kind of grind up higher in oil, and it could just be a lot of the moving other parts, but I'd expect that to kind of come back and focus. People potentially expecting more treats from Trump, as well as more posturing from kind of OPEC. And we've heard from potentially OPEC, the Saudis, threatening to maybe start to price oil in other currencies, not just kind of the US dollar. Again, structurally kind of thematic to the need for a separate kind of reserve currency, if you will. So week kind of ahead, we have ECB, FOMC minutes. ECB, again, I believe should be not as relevant as kind of before. FOMC minutes may get a little bit more kind of airtime. I still think there's going to be a lot of focus on just this kind of big move that we continue to have up in equities, as well as kind of bond yields rising. How much higher up can they kind of go if economic data continues to become better? And that's, of course, a big if we really are going to see a bit of a wave of improving econ data, or if last week maybe still is just a bit of hiccups, just a bit of green shoots. And then, of course, we have the latest in Brexit. So April 12th is the deadline that we seem to kind of at least have. There's a lot of people that think that that's going to get an extension. There's a lot of debate about how that extension is going to be, i.e., can the extension be post the May elections that we have in the European kind of Parliament, and then if so, what does that mean in regards to the UK staying in? I've also seen something saying that some people may actually be looking for a one-year extension, which to me is all kind of ridiculous, right? Because more time is not going to do anything. I actually think the longer the extension, for argument's sake, if we got something that was 6 months or 1 year, I actually think that would be negative on sterling, just simply because it's more time and kind of staring at kind of the abyss. This is dragging on economic data and so on and so forth. And some of you may have seen that the PMIs in the UK last week beat really, really strongly, especially on the manufacturing side. There's something like 55 versus the 50 that was expected, or something like that. And that's, of course, is people just, backing up kind of the inventory, not sure what's going to kind of happen before, not too dissimilar to what we saw in China towards kind of the back end of last year, and maybe even very, very early kind of this year with kind of the fear of kind of the tariffs. So that's kind of the things to kind of watch here. A longer extension is negative. A quicker kind of end towards the process, be it hard Brexit, be it kind of soft Brexit, is a lot more kind of positive on that. We'll touch on just a simple way of potentially thinking about this. I've been speaking to a lot of clients about this. Very, very different views, most bearish, some bullish, but at the same time, most people not quite sure how to kind of express it, given the kind of risks. And I'll just give you my 2 cents for what it's worth. So ECB, as we said, there's a few Fed speakers. Most important is, of course, going to be the chair, Vice Chair Clarida, and noted as we started that Oz and New Zealand had daylight savings over the weekend. We'll also have Kuroda speaking today, and OPEC meeting, I believe, is due for Thursday. Always hard to know when they start, when they end. I'm not even sure that they know themselves. From an econ data perspective, I think most key will be CPI out of the U.S. and China. Watch out for that. German trades balance could be interesting to just see if we're starting to see a bottoming out in the weakness that we've seen in kind of the exports and kind of imports. Also CPI there could be interesting. The other thing that maybe for out here to watch out for in the Asia Pacific could be visitor arrivals in New Zealand, as well as their manufacturing kind of index. I continue to believe that RBNZ's move was about the rest of the world rather than domestic kind of data, but try telling that to kind of the Kiwi and the Aussie Kiwi, which we'll check some charts out of soon. And then of course we got the RBA Financial Stability Review later on this week. So that's kind of the week ahead. Just a few things on the charts. This here is just showing you kind of last week snapshot against the U.S. dollars, kind of the base currency. This is G10. This is EM. You can see last week it was pretty much only the NOK and the Aussie that fared well against the U.S. dollar. The biggest losers were the yen and the Kiwi from a lagging kind of perspective. On the EM side, it was really only Thai baht and the Argentinian peso, with the rand far out front, outperforming at over kind of 300 kind of basis points. And these are always try and show as our total returns. So don't be surprised if you're not getting the same when you look at kind of spot. I thought it'd be also interesting to do it on sterling. So what I've done here is we have last week's performance. Here we have year-to-date performance on sterling. This is all focused on G10. And here we have since the beginning of 2016. So if you recall, the actual vote of Brexit in regards to kind of when the markets opened up was the 24th of June 16, right? So what this is basically showing is last week was our performance on sterling. The only ones that did better was similar to kind of the US dollar was the NOK and the Aussie. Year to date, it can also be seen that sterling's basically crushed G10. The only exception has been the loonie, and no doubt this is kind of linked to oil move kind of up higher, and the Swedish krona has actually fared the worst versus sterling. And this here is since the beginning of 2016. So this basically shows that sterling continues to underperform all of the G10. Maybe you could say against, with the exception of the SECI here, but for instance, the loonies are performing the most at over 22%. The euro at let's call it kind of 16 kind of percent over that kind of period. So this is just to give you a little bit of kind of a context of recent kind of price action, again in total returns versus kind of sterling, as well as kind of going back much further back to pre the Brexit kind of scenario, to give you a little bit of context of where we could be, right? This here is euro sterling, so obviously going up, favors euro, going down, favors sterling, and you can kind of see from all of these charts that we look on sterling when the actual kind of vote was, right? So prior to the vote, we're talking 70, kind of 75 kind of range, if you will, and then started to get big break up here. And then I believe we got to 97, 98 or something like kind of over here. And then recently we've just kind of been trending kind of lower since at least the start of kind of the year. And we're kind of around these, let's call it 86 kind of levels. We'll see a similar chart. This one here is cable. So obviously this one here was the vote going from kind of 145-ish kind of levels. I believe the low we entered here was, off the top of my head, kind of maybe 117 or something like that, 117 and a half, 118. Had a big run up to 140, then proceeded to sell off, and then basically for most of 2019 we are still up since the start of kind of the year, but now we've been kind of stuck in this, call it 130-ish, 131 kind of range, which is really where we are. So let's try and give some kind of context for people either expecting a positive or a negative kind of price action post the dates. And a simple way of just kind of looking at this is, if you don't want to take directional views just simply because you're not comfortable being able to kind of quantify how things could kind of move, then I think a simple way of playing this is just through one-touch options. And here I give the example of, if I'm running $100 million, just think of that as 100% of your own kind of book, be it $1 billion, be it $10 million, be it $1 million. And I want to use, say, 500K of premium, which is about 50 basis points, so 0.5% on potential sterling strength play. And I'm buying options because I want to be able to kind of, quantify my risk. So, my max loss is the premium I'm spending on these options, right? Rather than an outright position where you're not quite sure if any kind of stop would potentially be triggered at where you'd like it to be. Now, a thesis here could be, I think the worst is behind us. I think actually the structural bottoming out was in 2017. And I also think that despite whatever short-term pain we may get from a hard Brexit, the clearing of the dark Brexit skies, if you will, i.e. 2 to 3 years of funk, will far outweigh any kind of near-term kind of negatives. I also expect that, we did about minus 10% on Brexit vote and outcome, but that was a complete surprise. A hard Brexit now should not, in my view, give us a minus 10% kind of pullback on the likes of kind of cable. So here we're kind of looking at euro sterling for argument's sake. We'll have the next chart which will look at cable. But here let's say again, so I'm looking for a bullish outcome for sterling, so I'm expecting it to strengthen versus euro, so euro sterling to kind of go down. Here I'm expecting that we could drop by about 5% from these 86 levels, so to around 81.50, we could say. Right. So what I do is I get the one touches. I take the strike of 81 kind of 50. Here I'm taking about 6 months kind of maturity, thinking that I don't want to be caught out in something where the extension is in May or later on in back end of April or anything kind of like that. Of course, that's a risk. One could also just take out 1 year if one was kind of feeling that. And this here is kind of my premium, which here is about 500,000 US dollars, because that's what kind of my portfolio kind of is, right? Here is basically the size of the payout I'm looking for. That's what this 1.5 million implies. So what this basically says is, for spending close to 480,000 euros, I'm buying the one touches at 81.50. Spot is 86. I have until the 4th of October, and if it touches 81.50 anytime between now and then, even if it does it on the 3rd of October, then I'm getting a full payout of 1.5, which basically would give me roughly a return of about 213%. And that's not going to alter, irrespective of what happens on kind of the volatility side of things. Now, I don't have to wait for us to get to either October or for us to even get to 81.50. It could get to 82, and I could turn around and sell the one touches for whatever the premiums will be then, because obviously the closer we get to that, the more these premiums should basically kind of increase, right? So just for argument's sake, if we get to let's say 82, for instance, then this may be something like 50. 5% or something like that, or 65%, I don't know. But that's just to kind of give you a bit of kind of context. Obviously, if you have the opposite kind of view, I think actually there's a lot more worse to kind of come through. People have been complacent here. People are not as short of sterling as they used to be. We have the credit impulse getting worse and worse and worse, as Christopher Dembeck, our economist in Europe, has highlighted, and UK political risk is potentially intensifying with Corbyn potentially kind of coming in. Then you could be expecting euro to outperform. So you'd be expecting the upside of plus 5% from these 86-cent levels, which may take us, above 90 cents. So you could use that as a barrier entry. So looking for a move up. And again, kind of the same thing. This is your premium, and if that plays out, then you end up making kind of 100% based off of this metrics. Obviously, the shorter your time horizon, then the better potential kind of return that you kind of have. But I personally tend to think that most people have options that are way, way, way too short in the time kind of horizon. This here is kind of, again, the same idea on these one-touch kind of options. Here you're basically looking at cable. Same kind of idea. I prefer euro sterling, just given that I think it's just a pure play on what's happening between the UK and Europe, and I also believe that the UK has still shouldered most of the negative effects, even though it's obviously bearish for both sides. And here I'm just, get into the same thing. So from about spot levels of about 130.40, if it's a bullish play, I'm expecting, it to move up potentially above 5% within the next 6 months. So that's a 137 strike. And if it's a bearish play, then potentially move down 5%, which is 124, and ditto, just working out on kind of the same kind of premium. So what's the idea here? The idea here is kind of thinking like there's zero edge from, getting more information here, knowing how this plays out. No one knows how this plays out. But if you have a very strong view one way or another, at least you can quantify by saying I'm risking, 50 basis points or 100 basis points of my capital, whatever it is. And you could even do that in tranches. You could do half today. You could do another half, the balance towards the end of the week, etc., or do it in threes, again, depending on how you want to kind of think about it. And then you just leave it from that, because I just don't think there's anything to be gained from any kind of headlines or anything like that. It's very, very convoluted in regards to the opinions here. A lot of big macro traders would not touch this one way or another, but which to me is what makes it interesting. For me, the upside again is just so compelling, screaming-wise, that I'm surprised that not more people are looking at this and considering this, and just considering it kind of simply. I think people just kind of get caught up in kind of the weeds. So it's just a simple way of doing that, rather than trying to figure out what the hell Parliament keeps kind of voting on, and what potential kind of implications are kind of around that, right? So food for thought. And again, it's okay, obviously linked to kind of Brexit and linked to sterling in this case, but obviously this kind of thinking can be taken to other things as well, where you have a strong view one way or another, you're not quite sure what the edge is in regards to kind of deciphering kind of the information, so at the very least you can have some exposure and move on to kind of the next thing, which could be a little bit more productive. This I just thought would be interesting to have a sterling CAD chart. This here is a weekly, shows you just recent kind of CAD outperformance kind of coming here since basically back end of kind of March, right? And kind of, I guess you could argue, obviously since the actual election date, lower on sterling. This here is just cable. This is a quarterly chart, again, to give you kind of context of how low we are, at least from a historical kind of basis. At one point, I think this was when I was in London, cable was actually 2 versus kind of the US dollar, right? This is obviously GFC, and this here was obviously the vote kind of period. So this is kind of where we are, right? So again, from quarterly perspective, looks very, very, very low, very, very kind of inexpensive. Obviously, this also implies that if you're expecting to move to kind of 160, you probably have to give it some time to get to kind of 160, right? Here you can see it can easily take 2 years for something like that to kind of happen, right? So plan kind of accordingly from that kind of context. Euro sterling, again, just from a quarterly perspective, to give you, again, context of how high we are, or in this case, saying how this is a potential multi-generational kind of opportunity here on sterling, if I'm correct. And same here, sterling Aussie, again showing you that despite the RBA not yet cutting, despite a lot of the things kind of in issues that Aussies having Oz is actually still been doing quite well versus kind of sterling, right? So I don't think it's that aggressive to, let's say, target even a move to 2 or to 215, but potentially give that some kind of time to kind of play out. This year's sterling against Kiwi, kind of same things, except obviously fundamentals better in New Zealand than in Australia. Sterling versus Swissy, sterling versus yen. Again, same kind of implications, right? This is Aussie Kiwi, very, very kind of beautiful kind of break up higher. This, of course, was RBNZ. I was actually expecting us to go kind of sideways and to go back moving up. So I've been a bit surprised by the continued weakness in the Kiwi versus kind of the Aussie. Chart here is, of course, daily and still bullish. Definitely looks like 106 is more than doable, and then we should start kind of running into kind of heavy wood territory to kind of chop through between 106, kind of 107, where I'd potentially go back to rethink about maybe putting on some kind of shorts, but still kind of worth bearing in mind that RSI here not yet turning, but seems to be kind of leveling out, and also watching kind of the MACD kind of here. And again, same kind of view that RBNZ is more about the rest of the world rather than about kind of what's happening there. This is Kiwi. We're around this kind of 200-day, down about 4 basis points versus Aussie's 20 basis points this kind of morning. Still not turning around on RSI or MACD, but interesting nevertheless to see kind of where we are there. Over here is ZAR, again, more just pointing this out as I was surprised by the huge kind of resilience, almost 300 basis point move versus the US dollar last week. Actually not too sure what kind of drove that. Didn't get a chance to kind of put that up. But interesting to see us sub 200 and just a little bit above kind of the 100-day here. So interesting to kind of watch, I think, either way. On Euro Swissy, looking kind of constructive for the Euro. MACD crossing up higher. RSI sideways, but still definitely pulling out from oversold kind of territory. And this looks like 112.60, 113 could be a possibility. We do know that the S&P, do not want a stronger Swissy, so that's definitely something you have going for that cross. Same kind of thing. Again, MACD crossing up higher. This is Euro versus Yen. Definitely looks like 126 is a given. And then the bigger kind of move could be breaking that 126, get into 127, 127, 70 kind of floor. And again, what you have going for you here tactically is, of course, the positioning in Euro, where everyone on their goldfish is short. This here is Palladium. Pretty, again, explosive kind of move up higher. We've been breaking down lower. Looks like we're trying to base here and maybe make a push for 1400 back to kind of 1500. I'm kind of watching this to potentially kind of play from the short side of things, but it's looking a lot more kind of constructive here than it was last week. Let's see daily. This is Platinum. We're in the midst of what seems to be another kind of big breakout. This is not something I'll be looking to short anytime soon. If anything, it's more of a jump on kind of play. RSI still ticking up, as is kind of the MACD, but I'll continue to just kind of monitor this. This here is oil. Brent crude, very, very strong. Weekly close above 200-day. Again, it's been very, very robust in how we've kind of squeezed up higher. Off where the highs are compared to other things that we're kind of seeing. And again, as I said, we have an OPEC meeting as well. We're well above also the 20-day kind of moving kind of average. I'd expect this to start getting a lot more kind of headlines as people start to pay a bit more attention to it. This here is the energy ETF. As you can see, it looks like we're about to get above 200-day. Looks like it may have some kind of catching up to do, given a few of the performances of the other kind of ETFs in the U.S. I was kind of surprised to see the consumer discretionary ETF making all-time new highs, given where we should be in the business cycle. This definitely is not looking like there's a recession anytime soon, given kind of the price action that's been happening here. RSI very much still in overbought territory. MACDs don't look like they're going to be kind of crossing down anytime kind of soon. But could be interesting for some of you that potentially could be interested in playing some of these sector ETFs against kind of one another, relative value kind of trade-wise, or looking for a play in kind of our earnings. We'd also had a very big move last week in financials. So the last few charts are really going to be equity-based, and they're going to be focused really on China equities. And the context I'm trying to give here is a few things. One is the huge moves and the momentum that we're seeing, and how unlikely it is that they will continue to at this pace, and if they do, then the annualized rate is exceptional. Second will be kind of the volume, and then we'll also kind of go back and take a very quick look at how things played out in 2014, 2015, which was the last time that Chinese equities were on the epitome of fire, right? So this year's CSI 300, we're up about 38% in US dollar terms. That's around 160% annualized. And annualized is really how you should always be thinking of stuff. If your portfolio makes 15% overnight, again, this is assuming you're a trader, I mean, it's a bit of a no-brainer in my mind to kind of bank that, right? Because obviously annualized, that's a ridiculous amount of return in a short amount kind of time. So here, a clean, again, break up higher, very, very bullish. This here are just a daily chart, RSI up, MACD up. Yeah, just amazing. This here is a Shenzhen comp, strongest main China equity index, 44% year to date in US dollar terms. That's 180% annualized. Ditto kind of showing the same thing. In fact, you're soon going to be seeing the 100 MACD, or should I say the 100 moving day average above the 200, which is another bullish signal. RSI is not even overbought yet, right, compared to the levels that we were kind of at before. This here is the 300. Here we're basically showing now the moves from 2014 to 2015, right, on the Shanghai kind of comp. What is interesting is we are well off all-time highs, which is not something that can be said for a lot of the U.S. kind of equity indices names, right? Some ETFs are making all-time new highs, a lot of stocks making all-time new highs, etc. But what was astonishing was we've done about 40%, 38%, but this was kind of to give you a bit of context of what happened from 2014 to 2015. When we'd done about kind of 35, 38%, all we did was continue to kind of push up kind of higher up, which is quite astonishing. Not trying to say that that will happen again, but interesting to see. And of course, the majority of that came off in about 2 months. And this is something we keep hearing from our colleagues in Shanghai and other kind of data points. There's obviously that this is not something that the party and the PBOC is keen on seeing. They want this shift from basically Chinese residents to move their assets traditionally from real estate into equity markets and public kind of capital markets, but they don't want this kind of repeat of kind of gambling that we kind of saw. And if you recall at this time, we also had a lot of account openings and a lot of kind of leverage kind of plays, if you will. So I would not be surprised that if at some point we start to also hear, kind of curbing stories to try and kind of take us, wouldn't say lower, but at least stem the upward kind of ascent that we keep going. I mean, I'm still very, very amazed at the plus kind of 9% that we saw last week. And as you can see from here, still very, very bullish from an indicator kind of perspective. This here is, again, I've just basically just tried to go back and focus on this 2014, 2015 area. And that's what we're doing here. And these are weekly returns. So each bar is 1 week. And you can kind of see, a blue bar represents a down week. But you can kind of just see how strong the trend up was during this period with very, very few down weeks and the peak to troughs. And this is, when we made a new high and then we went down to, a new low from that new high. We're talking only 11%, right? And then another small down week. Another one here that was down about 8%. Another one here that was down about, call it 2.5%, if you will. And I guess the point here is just how strong and how remarkable the ascent was. And the question then is, are we kind of, in something like that, right? So kind of playing a bit of devil's advocate to just kind of look into what kind of happened kind of previously, right?